The global artificial intelligence market was valued at roughly $214 billion.
Right.
But by 2030, that number is projected to rocket to $863.79 billion.
Yeah, which is just, I mean, it's a massive 32.19% compound annual growth rate.
It's unbelievable. And, to make that actually happen, the macroeconomic projections suggest that between 2025 and 2030, the global capital expenditure required for all this AI development and deployment, it's going to land somewhere between $5 trillion and $8 trillion.
Wow.
Yeah. So welcome to another custom-tailored deep dive. Today, we are figuring out how you can capture a piece of what might genuinely be the largest wealth transfer in human history.
I mean, it is a staggering amount of capital. Just trillions of dollars reallocating across the entire global economy. This isn't just, a software update. It is the construction of an entirely new foundational digital infrastructure.
Okay, let's unpack this, because going from $214 billion to nearly $900 billion, fueled by up to $8 trillion in capex, that is it's a tidal wave of money.
It really is.
And for you listening right now, whether you are prepping for a strategy meeting, or you're trying to catch up on the tectonic shifts in the market, or maybe you are just looking to allocate your own portfolio, you are someone who wants to cut through the noise.
Exactly.
You want to get straight to the aha moments of investing in tomorrow's technology. You don't want to just stand on the beach and watch this wave crash. You want to harness it.
And harnessing it, it requires a highly specific lens. I mean, we are moving way past the theoretical hype of AI and entering the actual deployment phase.
Right, the execution.
Yeah. So our mission today is to really demystify the elusive multi-bagger stock in this space.
And just to clarify, a multi-bagger being an equity that multiplies your initial investment several times over, like 10
Yeah.
times, 20 times.
Exactly. 10 baggers, 20 baggers. And we aren't just throwing out buzzwords today.
No, definitely not.
We are going to break down a scientifically rigorous, empirically backed framework that's designed specifically for a beginner investor to identify these massive winners.
But I feel like before we can pick the winning stocks, we have to fundamentally understand what an AI company actually is today.
Right. That's crucial.
Because when I look at the source material, it's clear it's no longer just like a couple of coders in a garage making a quirky chatbot. The definition has shifted to something called the AT domain.
The advanced technology domain, yeah. This is a really critical definition to establish early on. When we talk about the AT domain today, we are talking about massive infrastructural powerhouses.
Wait, let me stop you there. Because when I first saw AT domain in the notes, my mind instantly flashed back to the early 2010s.
Oh, right. The domain name craze.
Yeah, exactly. When people were buying up internet domain names, hoping to flip them, entities like the Domain Developers Fund were treating internet domains like digital real estate.
Right, right.
You bought a catchy URL and just hope someone would pay you 10 times more for it later. We need to be crystal clear for the beginner investor that this is not what we're talking about here.
Oh, not at all. No, that was pure speculation on digital real estate. The modern AT domain encompasses the heavy hitters that are driving the physical and digital realities of artificial intelligence.
Okay.
We are talking about semiconductor design, the architectural blueprints of the chips.
The hardware.
Yeah. And we're looking at cloud-native infrastructure, the training of foundational models, and the digital engineering firms that actually apply these models to legacy industries.
Which is super interesting because our source material points out a fascinating bifurcation happening in this industry. It's really splitting into two distinct operational tiers.
It is, yeah.
You've got the hyperscalers on one side and the applied layer on the other.
Right.
And instead of just listing what they do, let's look at the actual mechanics. If we compare this to, say, the construction of the interstate highway system, how do these two layers interact?
That is a highly functional analogy, actually. So the hyperscalers are the ones laying down the asphalt and building the massive electrical grids.
The core infrastructure.
Exactly. These are the mega cap technology conglomerates. They are literally the only entities with balance sheets massive enough to fund gigawatt-scale data centers.
Wow.
Because developing the next generation of foundational AI models by 2030, it will require investments of hundreds of billions of dollars per individual model. Per model. The sheer volume of computational power, what they call compute scaling, is incredibly capital intensive. It's slow, heavy, foundational work.
So, as an investor, you generally don't want to invest your capital solely in the concrete of the highway. Because the margins on pouring concrete eventually compress over time, right?
Exactly.
Want to invest in the logistics fleets, the FedEx and UPS equivalents,
Yeah.
that use that highway to deliver specific high-value packages to specific doors.
Yes.
And that brings us to the applied layer.
Correct. So the applied layer consists of the domain-specific software companies and the digital engineering firms.
Yep.
They do not build the gigawatt data centers. Instead, they construct proprietary, highly specialized applications on top of the foundational models provided by the hyperscalers.
So they're monetizing the route.
Right. They're monetizing the route. And the reason both of these layers are attracting trillions in capital is because they are generating something the global economy has never actually seen before.
Which is
Scalable digital labor.
scalable digital labor. Man, the research notes that AI is poised to automate 34% of remote-compatible tasks in developed economies.
That would be 4%.
Think about the mechanics of that for a second. By the end of this decade, advanced AI systems could effectively function as autonomous digital agents. We aren't talking about a spell checker here.
No, not at all.
We are talking about automating a third of all remote tasks. It fundamentally alters the scope of an AI company from just selling a software license to, like, leasing you an incredibly efficient workforce that doesn't sleep or take vacations.
It does, and the economic implications of that are just staggering. But there is a massive divide in how quickly that labor can be deployed.
How so?
Well, it depends entirely on whether the AI is operating in the digital realm or the physical realm. And this is a vital distinction for investors who are trying to model future cash flows.
Okay, let's explore that divide. If an AI is doing a digital task, like parsing a billion data points or writing code, the deployment is almost instantaneous, right?
Right, because there is zero physical friction. The most immediate, outsized financial returns are found in these digital services.
Makes sense.
An AI can restructure a database in seconds, and that output is deployed instantly across a global network. The value creation is immediate, but...
And when it hits the physical world.
Exactly. When AI attempts to step off the screen and manipulate the real world, it collides with severe regulatory and physical bottlenecks.
Right. And the source material uses pharmaceutical drug development to illustrate this, which I think is a perfect example.
It is.
Let's look at how that actually works. We have a company mentioned, Iambic Therapeutics, and they're using an advanced AI model called Enchant.
Right. And the Enchant model is a brilliant piece of technology because AI is incredibly adept at the digital discovery phase of pharmaceuticals.
Right, the early lab stuff.
Yeah. It can predict biomolecule interactions, simulate how a novel chemical compound will fold, and identify binding affinities in just a fraction of the time it takes human researchers.
Wow.
The Enchant model actually cuts years off the traditional preclinical timeline and reduces those associated R&D costs by up to 50%.
Which is huge.
Yeah.
Cutting R&D costs in half is a monumental financial advantage.
Absolutely.
But the bottleneck happens the moment that digitally perfected molecule actually has to be ingested by a human being.
Yes. The final phases of clinical trials, the physical, regulated, human-centric part of the process.
You can't fast forward that.
No, it cannot be bypassed by an algorithm. You still need human cohorts. You still have to wait months or years to observe physiological side effects. The existing really stringent regulatory frameworks of the FDA and the EMA, they are firmly in place. So, while the digital discovery happens in days, the physical approval still takes years.
So the takeaway for the investor here is to look for the immediate compounding returns in digital services and infrastructure first.
Yes.
The physical deployments will face speed bumps. But that doesn't mean AI is useless in legacy industries. In fact, our sources highlight that the long-term survival of the AT domain relies entirely on what they call intersectoral symbiosis.
Yes, intersectoral symbiosis.
Which basically means where AI integrates into traditional economic sectors.
Right, and that symbiosis is where the theoretical value of AI translates into actual corporate earnings. Let's stay with healthcare for a moment, but move away from the drug trials and into operational medicine.
Okay.
AI is shifting the entire paradigm there from reactive care to predictive care.
Meaning we stop waiting for a patient to present symptoms and instead use AI to identify complex disease patterns in, like, medical imaging long before the patient even feels sick.
Exactly. And beyond the clinical diagnostics, AI is automating the massive administrative burden.
Oh, the paperwork.
Yes, scheduling, resource allocation, and patient triage are being algorithmically optimized.
Wow.
This liberates healthcare professionals to focus entirely on patient care, which drives down systemic costs significantly. However, implementing this requires a profound organizational shift.
And that brings us to an incredibly important framework from the Boston Consulting Group, or BCG. It's the 10-20-70 rule.
Yes.
I think a lot of people assume AI integration is just writing a big check for new software, installing it, and you're done. How does this rule change that perspective?
The BCG 10-20-70 rule is essentially the blueprint for successful generative AI transformation, and it is highly counterintuitive for a lot of executives.
Okay, lay it out for us.
It states that only 10% of a company's effort and resources should be focused on building the actual algorithms.
Wait, just 10% on the core tech?
Just 10%.
That almost implies the algorithm itself is becoming a commodity.
In many ways it is. The foundational models are readily available. Another 20% of the effort must be focused on the underlying infrastructure.
Like what?
The internal data pipelines and cloud environments that are actually required to feed the algorithm.
Okay, so that is 30% of the total effort spent on technology.
Right.
What makes up the massive 70% remainder?
The remaining 70% must be dedicated entirely to organizational culture and process adaptation.
Which basically means retraining your human workforce.
Retraining humans, restructuring operational workflows from scratch, and fundamentally changing the corporate culture to actually trust and utilize these new digital tools.
Yeah, that makes sense.
Because if leadership fails to execute that 70% cultural adaptation, the 30% they spend on the technology just becomes a stranded asset.
Right.
The AI will just sit there unused because the human layer rejects it.
Okay, let's look at a sector that actually embraces that 70% adaptation brilliantly, which is financial services.
Yeah, great example.
Historically, finance is heavily regulated by bodies like the SEC, but they have managed to implement AI at massive scale without breaking systemic trust.
Because financial institutions operate in environments entirely driven by data, which makes them perfect candidates for AI integration.
Sure.
They are deploying sophisticated, forward-looking predictive forecasting engines. They manage real-time fraud detection by analyzing millions of microtransactions per second. And they perform instantaneous actuarial risk assessments and optimize high-frequency trading.
But, the detail in the research that I found absolutely fascinating was the use of generative AI for personalized financial advice.
Oh, the tone adaptation.
Yes. They're using dynamic tone adaptation algorithms. How does a tone adaptation algorithm function mechanically in a client meeting?
It acts as an automated hyper-rational behavioral buffer.
Okay.
So the algorithm analyzes the client's sentiment during interactions, particularly during periods of high market volatility.
Like a crash?
Exactly. If the broader market is crashing and the client's inputs indicate panic or extreme distress, the AI dynamically shifts its conversational tone.
Really?
Yes. It deploys stabilizing, highly structured language to calm the client and prevent irrational selling.
And on the flip side, if the client is experiencing irrational exuberance, say, they want to liquidate their entire retirement account to go buy a volatile meme stock, the AI tone adapts to become cautious and interrogative, basically bringing them back to reality.
Exactly.
It's like an automated financial therapist.
It really is. And what's fascinating here is that its success proves these advanced technologies can operate safely and effectively within strict ethical and regulatory constraints.
Right.
It is an excellent indicator for investors looking at applied layer companies specializing in finance.
Which brings us to the third industry in our intersectoral tour, and perhaps the most surprising one, which is heavy industry. Specifically what the research calls Mining 5.0.
Yes. Mining 5.0 is arguably the most consequential application of AI for the physical economy. To understand the leap, we have to look at the progression. So, Mining 1.0 was basic mechanization.
Okay.
Mining 2.0 brought electrification. Mining 3.0 introduced early computerization. And Mining 4.0 was characterized by fragmented process automation.
Let's dissect that phrase for a second. Fragmented process automation. The research notes that Mining 4.0 created massive integration debt.
Yes.
I want to be clear on what that actually looks like on a job site.
Integration debt occurs when a company installs highly advanced IoT sensors and automated systems on isolated pieces of equipment.
Okay.
But those systems possess no mechanism to communicate with one another. So you might have a fully autonomous drill, but it cannot communicate its data to the automated ventilation system or the logistics fleet.
That's a problem.
You have a collection of incredibly smart machines trapped in a dumb, totally disconnected ecosystem.
So Mining 5.0 steps in to pay off that integration debt. AI companies create a fully connected, intelligence-driven operational ecosystem. And the standout example in the source material for this is the Pangu Mine model.
Yes. Launched jointly by Huawei and Shandong Energy Group, the Pangu Mine model is the world's first commercial AI model dedicated explicitly to the energy sector.
And it doesn't just do one thing, right? It optimizes 21 specific operational scenarios.
Correct.
We are talking about automated coal preparation, complex rock burst prevention. Let's think about how that works mechanically. AI uses thousands of acoustic and seismic sensors deep underground to analyze microfractures in the rock in real time,
Yeah.
predicting a deadly collapse before a human engineer could ever sense the pressure shifting.
It also provides real-time thermal monitoring of underground electromechanical equipment, uses visual and thermal AI to detect minute friction anomalies in conveyor belts and massive machinery.
Averting catastrophic fires.
Exactly. It is actively preventing fatalities in one of the planet's most hazardous
It's
environments.
like a gold rush, right? You've got the hyperscalers building the railroads and the applied layers finding the gold.
Yeah, and if we connect this to the bigger picture, the relationship between AI and mining is a perfect feedback loop.
How so?
Well, remember those gigawatt data centers the hyperscalers are building?
The foundational infrastructure that requires immense electrical transmission and continuous cooling.
Exactly. To build and scale that hardware, the AT domain requires an exponential increase in critical minerals.
Oh, I see.
They need unbelievable amounts of copper to wire the data centers and electrify the grid. They need lithium and rare earth metals for energy storage and advanced components.
Wow. So the implication there is that the AI industry's growth is entirely tethered to the efficiency of the mining industry itself.
It is. By deploying the Pangu Mine model to optimize and accelerate resource extraction in Mining 5.0, these AI companies are actively securing the raw physical materials necessary to build their own computational future.
It is literally a closed-loop system of survival.
Right.
Okay, so we've mapped the territory. We understand the sheer scale of the AT domain. We know the difference between the hyperscalers pouring the concrete and the applied layer driving the delivery trucks.
Right.
We see how AI is physically and digitally changing healthcare, finance, and heavy industry. But now we have to answer the trillion-dollar question for the listener.
The big one.
How do we actually find a company whose stock will multiply 10 times over?
Right.
Right now, every single company with a stock ticker is slapping the letters A and I onto their quarterly earnings reports. We need a way to strip away the hype.
We do, because relying on narrative-driven investing, buying a stock simply because the CEO mentions AI 15 times on an earnings call.
Which happens a lot.
It happens all the time, and it almost invariably leads to severe capital destruction. We need to replace the narrative with mathematics.
This brings us to Section 2, the beginner's blueprint to multi-baggers.
Yes.
Our source material relies heavily on a deeply researched mechanism called the Yartseva statistical framework.
Right. Anna Yartseva conducted an extensive 15-year panel regression study. It was titled The Alchemy of Multi-Bagger Stocks.
Great title.
Yeah, she analyzed 464 distinct equities across the NYSE and NASDAQ that delivered massive multi-year returns between the years 2009 and 2024.
Okay.
The goal was to find the quantitative DNA of a massive winner.
And what makes this study so vital is that it immediately destroys several massive myths.
So complete.
Things that beginner investors and frankly a lot of institutional managers assume are the hallmarks of a great growth stock, but actually are not. Let's start with the biggest myth. Top-line revenue growth.
The empirical findings debunked the idea that pure top-line revenue growth is the ultimate predictor of a multi-bagger.
Really?
Yeah, screening purely for massive sales growth or even traditional earnings metrics like EPS earnings per share or EBITDA failed to show consistent predictive power for outsized winners over a 10-year horizon.
Wait, I need to challenge that. If a company is doubling its revenue every single year, if the sales are exploding, why wouldn't its stock be skyrocketing permanently?
Yeah, because revenue generation in a vacuum tells you absolutely nothing about the cost of that revenue.
Oh.
A company can easily double its top-line revenue by spending wildly on customer acquisition, aggressively expanding marketing budgets, or intentionally selling products at a massive loss just to gain market share.
They're just buying revenue.
Exactly. If a company is burning through massive amounts of cash to achieve that revenue, the growth is a mirage. It is fundamentally unprofitable growth.
Right.
And eventually, the market realizes the business model is a furnace for capital, not a generator of it.
So, if pure revenue isn't the golden ticket, and basic earnings like EBITDA aren't enough, what is the core metric we should be looking at?
The study found that the single strongest quantitative signal for identifying a future multi-bagger was a metric called free cash flow to price, or FCF over P.
Let's break that down entirely, because FCF over P is going to be the bedrock of this strategy.
It is.
What exactly is free cash flow, and why does it matter more than EBITDA?
Let's look at it sequentially. EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Right.
It is an accounting metric that shows operating profitability, but it ignores the very real costs of maintaining the business.
Okay.
Value investors often view EBITDA with extreme skepticism because it pretends that capital expenditures, like replacing broken servers or upgrading physical equipment, don't cost real money.
Right. EBITDA assumes the data center never ages and the servers never melt.
Exactly.
But in reality, you have to buy new ones.
Yes. Free cash flow, however, is the brutal truth.
The brutal truth.
It is the actual hard cash a company generates from its operations, completely net of the capital expenditures needed to maintain those operations.
So it's what's actually left.
It is the money left in the bank account after all the employees are paid, the taxes are settled, the interest-on debt is covered, and the broken equipment is replaced.
It's the money a company can actually use to pay dividends, pay down debt, or aggressively fund AI research without having to beg Wall Street for another loan. So that's the numerator, free cash flow. And we compare that to the price of the stock.
Yes. The FCF over P ratio compares the free cash flow per share to the current market price of the stock.
Okay.
Yurtsevo's analysis proved that companies starting with a high FCF over P ratio, meaning they were priced cheaply relative to the massive amounts of actual cash they were printing, vastly outperformed the broader market.
Wow.
You are effectively buying a highly efficient cash-generating engine at a severe discount.
That makes perfect logical sense. You want the cash, not the accounting fiction.
Right.
What was the next major filter in the framework?
The size factor. If your goal is to see a stock multiply by a factor of 10 or 20, the company requires a massive compounding runway.
Which means it has to start small.
Exactly. You cannot realistically expect a company that is already valued at $3 trillion to suddenly become worth $30 trillion. The law of large numbers creates structural gravity.
So we are hunting in the smaller pools.
The Yurtseva study revealed that the median starting point for stocks that successfully grew tenfold was a market capitalization of merely $348 million, alongside annual revenues of roughly $702 million.
That's pretty small.
Yeah.
The source explicitly mentions targeting a total enterprise value, or TEV, of under $2 billion.
Yes.
Let's clarify TEV for the listener, because it's different from market cap, right?
It is a more comprehensive metric. Market capitalization is simply the total value of all outstanding shares.
Right.
Total enterprise value, however, calculates the entire theoretical takeover price of a business.
How so?
It takes the market cap, adds any outstanding debt the company holds, because a buyer would have to assume that debt, and then subtracts the cash the company holds on its balance sheet.
Okay, that makes sense.
Screening for a TV under $2 billion ensures you are targeting companies small enough to experience explosive, nonlinear growth.
Okay, so we have our baseline. We want a cash printing machine, which is high FCF over P, that is relatively small, meaning TV under $2 billion.
Right.
Now we put these companies through the fundamental screening gauntlet. A step-by-step checklist. The first metric in the gauntlet is ROCE.
ROCE stands for Return on Capital Employed. It is arguably the most critical measure of management's fundamental competence.
Okay.
For an AT domain multi-bagger candidate, the Yurtseva framework demands an ROCE consistently greater than 15%, ideally pushing above 20%.
Let's create a hypothetical company X to demonstrate this.
Yeah.
What does a 20% ROCE actually look like mechanically?
Okay, imagine company X has a total pool of capital, which includes both shareholder equity and long-term debt totaling $100 million.
Okay.
That is the capital employed. If they generate an operating profit of $20 million from that specific capital base over the year, their ROCE is 20%.
Right.
It means for every dollar entrusted to the management team, they generate 20 cents of raw profit annually.
And the research makes a specific point about ROCE in the technology sector versus gross margins. Why is high ROCE so specific to the bifurcation we discussed earlier between hardware and software?
Well, it perfectly illustrates the difference in capital intensity. Consider a semiconductor fabrication plant, the hyperscaler hardware side.
Concrete pours.
Right. Building a chip foundry costs tens of billions of dollars. The capital employed is astronomically high.
Yeah.
Therefore, to generate an ROCE of 20%, their pure dollar profits must be massive just to compensate for the weight of that initial capital outlay.
But on the applied layer, the software side, the math is totally different.
Drastically different. A digital engineering firm building AI applications does not need a $10 billion factory.
Right.
Their primary capital investments are human intellectual property and leased cloud compute. Their capital employed might only be $50 million.
Okay.
So, to hit a 20% ROCE, they only need to generate $10 million in operating profit.
I see.
Screening for high ROCE inherently filters for companies that extract maximum efficiency from every dollar, heavily favoring the asset-light nature of advanced software.
Okay, so ROCE must be greater than 15%. Next up in the gauntlet, debt.
The debt-to-equity ratio must be strictly less than mere 0.5. However, the ideal scenario and the most common trait among true 10-baggers is absolutely zero debt.
Zero debt is incredibly strict. Why be so merciless regarding leverage, especially when debt can technically amplify returns if used correctly?
Because debt introduces systemic fragility, and the AT domain requires the exact opposite. Technology evolves at a hyper-exponential rate.
Right.
If an AI company is trying to fund generative model research, they need every available dollar of free cash flow directed into R&D.
Oh, yeah.
If they have massive debt obligations, that cash flow is instead diverted to paying interest to bondholders or banks.
Which slows them down.
Exactly. Furthermore, high debt introduces restrictive borrowing covenants. If the market experiences a cyclical downturn, a heavily indebted tech company faces insolvency risk.
And you can't be a multi-bagger if you're bankrupt.
You cannot achieve multi-bagger returns if the company goes bankrupt during year 3 of a 10-year cycle. Zero debt guarantees survival.
That makes perfect sense. Next metric, margins.
The framework requires sustained net profit margins greater than 10 to 15%.
Okay.
This is not just an accounting check. It is proof of a deeply entrenched economic moat.
Meaning they have pricing power.
Precisely. If a company can sustain a 15% net profit margin over several years in a highly competitive sector like AI, it proves their technology is unassailable.
Right.
It means competitors have not been able to replicate their algorithms and undercut them on price. It demonstrates that clients are willing to pay a premium because the specific AI solution provided is mission critical and irreplaceable.
Okay, we have high return on capital, zero debt, and unassailable margins. We've verified the financial machinery.
Yes.
But in the AT domain, the machine is only as good as the human steering it. We need a way to quantify management quality.
And the quantitative proxy for management alignment in the Yurtseva framework is the intense scrutiny of promoter holdings.
Promoter holdings. For listeners accustomed to U.S. terminology, we can look at this as insider ownership, founder shares, or management's direct stake in the equity.
Exactly. The framework dictates that the promoter holding should ideally be above 45 to 50%.
To use a familiar concept, it's like a chef eating their own cooking.
Right.
If the head chef owns 50% of the restaurant, you know they care deeply about the quality of the food. They have significant personal wealth tied directly to the long-term success of the business.
Yes.
They possess unwavering, localized confidence in their proprietary AI models.
That alignment is crucial. However, the framework includes a vital, non-negotiable caveat regarding those holdings.
What's that?
It is absolutely meaningless if the founder owns 50% of the shares, if there's any pledging of those shares. The requirement is zero pledging.
Zero pledging. Let's really break this down because understanding the mechanics of share pledging is how investors avoid total portfolio destruction.
It is.
What does it actually mean to pledge a share?
Share pledging occurs when a founder or major shareholder uses their equity in the company as direct collateral for a personal or corporate bank loan. Imagine the CEO of our hypothetical company X owns 50% of the stock. They want to buy another company, or perhaps a massive personal estate, so they pledge half of their shares to a major bank to secure a massive line of credit.
They have essentially mortgaged their ownership stake.
Exactly. Now, consider the profound structural danger this introduces. The AT domain, by its nature, is highly volatile.
Sure.
Let's just say a macroeconomic shock occurs or a competitor releases a slightly better AI model, and company X's stock price drops by 30% over a few weeks.
The underlying business might still be fine, but the stock price takes a hit.
But the bank holding those pledged shares doesn't care about the underlying business. They care about their collateral.
Oh, wow.
As the stock price plummets, The value of the collateral drops below the required threshold of the loan. The bank immediately issues a margin call.
And what does that mean?
They demand the CEO deposit millions of dollars in cash immediately to cover the shortfall.
And if the CEO doesn't have the liquid cash,
The bank ruthlessly and automatically liquidates those pledged shares.
just sells them all.
They dump millions of shares onto the open market at whatever price they can get. This sudden, massive flood of selling pressure triggers a death spiral.
Wow.
The stock price collapses entirely, triggering panic selling from retail and institutional investors alike. A fundamentally sound company can see its equity valuation destroyed in days simply because the founder was over-leveraged.
I want to emphasize that for the listener. A margin call on pledged shares is a mechanical liquidation. It has no emotion, no belief in the AI thesis. It just sells.
Exactly.
That is why zero pledging is the ultimate red flag filter. You want the chef eating their own cooking, but you must verify they haven't mortgaged the kitchen to a loan shark.
Exactly. It ensures the equity structure is robust against market volatility.
Okay, so let's synthesize this. We have found a company. It's a small cap with a TE under 2 billion. It prints cash, yielding a high FCF over P. It has an ROCE of 20%, zero debt, 15% margins, and a founder who owns 50% of the unpledged stock.
A perfect setup.
We buy it. Now what? How does this mathematically turn into a 10x or 20x return? The source material talks about the valuation engine and the mechanics of PE re-rating. Walk us through the math of a PE re-rating step by step.
The PE re-rating is the dual engine mechanism that creates a multi-bagger. It is the combination of two simultaneous mathematical forces.
Okay.
Force number one is fundamental earnings compounding. Let's bring back our company X. Let's say they are currently earning $1 per share in profit, and they are successfully growing that profit by 25% annually.
Okay, a 25% growth rate.
Due to the mathematical certainty of compounding, a 25% annual growth rate dictates that the company's underlying earnings will double approximately every 3 years.
Right.
So in year 1, they earn $1 per share. In year 3, $2. In year 6, $4. In year 9, $8. In year 12, they are earning $16 per share.
So simply because the business is executing perfectly, the earnings have multiplied by 16 over 12 years. If the valuation multiples stayed exactly the same, the stock price would be 16 times higher. That's the first engine.
Yes, the fundamental growth. But the true explosive nature of a multi-bagger comes from the second engine, multiple expansion.
Okay.
The price to earnings, or PE ratio, measures how much the market is willing to pay for $1 of those earnings.
So if a stock trades at $25 and earns $1 per share, the PE is 25.
Correct. When company X is small and relatively unknown, it might trade at that PE of 25.
Right.
But as it continuously proves, it can compound earnings at 25% annually, especially in a massive total addressable market like AI institutional capital takes notice. Mutual funds and hedge funds begin accumulating the stock.
The big money enters the room.
And that massive institutional demand forces the PE multiple itself to expand. The market collectively decides that this highly reliable hypergrowth earnings stream is inherently more valuable.
Ah.
The market re-rates the stock. So instead of being willing to pay 25 times earnings, the market is now willing to pay 50 times earnings.
Let's do the final math on that.
Right.
The earnings grew from $1 to $16.
Right.
But the multiple applied to those earnings grew from 25 to 50. So instead of a 16x return, you are getting a 32x return on the stock price.
Yes.
The earnings multiplied, and the premium paid for those earnings multiplied simultaneously.
That phenomenon, earnings growth colliding with multiple expansion, is the absolute definition of PE re-rating.
Wow.
It produces the highly sought-after nonlinear wealth generation characteristic of the greatest stocks in history.
And this is the gravest warning in the entire study, you cannot overpay at the start. If you overpay, you completely neutralize the second engine.
Overpaying destroys the mathematical probability of multi-bagger. Let me explain why.
Please do.
If you find a fantastic AI company, but the hype is so extreme that the stock is already trading at a PE ratio 100, the market has already priced in a decade of flawless execution.
Right.
The multiple cannot realistically expand from 100 to 200. It is much more likely to contract.
We've seen this happen. The source material hints at the danger, but let's ground this in reality. Imagine a company trading at 100 times sales simply because they had a great AI pitch deck.
Yeah.
The moment they miss their quarterly earnings estimate by a single penny, the narrative breaks.
Oh, completely.
The institutional money flees, The PE multiple collapses from 100 down to 30, and the stock price craters 70% in a week, even though the company is still technically growing.
That is multiple contraction, and it is the destroyer of wealth. Yartseva's analysis found that the median starting valuations for actual 10-baggers were counterintuitively low.
Really?
They started with a price-to-sales ratio of just 0.6 and a price-to-book ratio of 1.1.
Finding an AI stock trading at less than 1 times its sales today sounds almost impossible.
It is exceedingly difficult in a hype-driven market. That is why the framework relies on the PEG ratio to enforce valuation discipline. PEG stands for price earnings to growth.
Wait, let's pause. What exactly is a PEG ratio? If I'm a beginner, I know price and earnings, but how does growth fit into that fraction mathematically?
It's a vital calculation. You take the company's price-to-earnings ratio, the PE, and you simply divide it by the company's projected annual earnings growth rate.
Let's use Company X again. They had a PE of 25, and their earnings were growing at 25% a year.
So you divide 25 by 25. The PEG ratio is exactly 1.0.
And what does a PEG of 1.0 signify?
A PEG of 1.0 historically implies a stock is perfectly fairly valued relative to its growth.
Okay.
The market is paying exactly what the growth is worth. However, the Yartseva framework demands a margin of safety. It requires finding equities with a PEG ratio of less than 1, ideally 0.7 or 0.8.
Which means you need to find a company growing at 30% a year, but trading at a PE of only 20.
Exactly. You are demanding a mathematical discount on future growth. This is the hardest part of the framework psychologically.
I can imagine.
The ideal entry point is almost always when a company's price momentum is negative. Perhaps they are trading near a 12-month low due to broader macroeconomic fears, yet their underlying fundamental machinery remains absolutely pristine.
The ROCE, the cash flow, all that.
Yes, you are buying the cash machine while the broader market is irrationally discounting it.
You have to step in when everyone else is stepping out.
Yeah.
Okay, the theory is exhaustive and mathematically sound, but theory is useless without application.
Very true.
Let's move to Section 3. Real-world case studies. Our sources apply this exact framework to a specific geography experiencing massive structural tailwinds. India.
Right.
Why India? Why not Silicon Valley?
The Indian AT ecosystem is currently a fascinating confluence of macroeconomics and technological capability. It is rapidly evolving from a legacy IT outsourcing hub into a foundational global center for AI engineering and proprietary cloud deployment.
And the big players are absolutely recognizing this. Microsoft has committed an unprecedented $17.5 billion between 2026 and 2029 to advance India's AI infrastructure.
Yes.
Google is pledging $15 billion spanning 2026 to 2030. These are sovereign-level capital commitments. What is driving that specific capital flow?
Two primary macroeconomic realities. First is the global rise of data localization mandates. Governments, including India's, are increasingly passing strict regulations requiring that data generated by their citizens must be stored, processed, and trained on servers physically located within that country's borders.
So hyperscalers must build local data centers to comply.
Exactly. Second is the highly favorable unit economics. The cost of advanced digital engineering talent and infrastructure scaling is significantly lower than in Western markets, allowing for incredibly high ROCE.
So the soil is incredibly fertile. The source material provides 5 specific companies that have been run through the Yartseva framework.
Yes, let's look at them.
Let's walk through them, not just as a list, but examining exactly how they integrate AI and how their metrics hold up. Let's start with Persistent Systems.
Persistent Systems is a prime example of a company surviving the technological transition. They successfully pivoted from a legacy IT maintenance provider into an advanced product and digital engineering platform.
How does their AI integration actually work?
Their core operational moat lies in their proprietary generative AI architectures, specifically platforms named Sasavia and GenAI Hub.
Okay.
They do not build foundational models from scratch. Instead, they embed autonomous AI agents directly into the deeply complex legacy workflows of massive enterprise clients.
So they're constructing the digital workers we discussed earlier.
Precisely.
Let's check their metrics against the framework. For FY25, they posted annual revenues of $1.41 billion, representing an 18.8% year-over-year growth.
Yeah.
Net profit hit 14,002 million rupees, which is a 28% year-over-year growth.
And critically, their profit growth is vastly outpacing their revenue growth.
Which means
This indicates operating leverage. It proves that as they deploy these AI agents, their margins expand. They're demonstrating the consistent earnings compounding required for the first engine of a PE re-rating.
So Persistent is building the broad digital workforce. But what happens when you need AI in an environment that has zero tolerance for error? That brings us to our second company, Oracle Financial Services Software, or OFSS.
OFSS operates in the hyper-regulated global finance sector. As a direct majority-owned subsidiary of Oracle Corporation, they provide mission-critical IT infrastructure to global banks.
So they aren't just giving a bank a chatbot.
No. They are integrating predictive AI, complex risk management algorithms, and high-frequency data processing through Oracle's advanced cloud infrastructure.
Wow.
Because core banking systems are so heavily regulated by central banks and financial authorities, providing reliable, secure, and compliant predictive AI is an incredibly entrenched and lucrative business.
Let's look at the financial fortress they've built. Operating margins are sitting at a massive 51.65%. A return on equity of 29.3%, and the ultimate requirement of the framework, absolutely zero debt, plus a dividend yield exceeding 3%.
OFSS maps perfectly to the stringent quality requirements of the framework. It possesses a pristine balance sheet, massive pricing power evidenced by the 51% margins, and the zero debt profile ensures they can fund ongoing R&D without restrictive covenants.
So OFSS proves that AI works brilliantly in a rigid, highly regulated environment like banking. But what about the Wild West of consumer data? How do you measure AI efficiency when user attention is the actual product?
That's a great question.
That brings us to company number 3, and frankly, the most fascinating business model on the list, Apple 3i.
Apple 3i operates in the global consumer intelligence and targeted mobile advertising space.
Okay.
And from a Yardseva framework perspective, they present the perfect size factor for dramatic compounding, with a market cap of roughly 20,321 cores, which translates to a highly agile total enterprise value.
But here's where it gets really interesting, their business model. They use complex AI algorithms to predict consumer behavior and serve targeted mobile ads.
Right.
But it's how they charge their clients that is revolutionary. It's called the CPCU model. Tell us how that mechanically works.
CPCU stands for cost per converted user. To understand why this is a moat, look at traditional digital advertising.
Yeah.
Historically, an advertiser pays for impressions, how many times an ad appeared on a screen, or for clicks. They pay for the attempt, regardless of whether that user actually buys a product or downloads the app.
You pay for the billboard on the highway, even if every driver ignores it.
Precisely. But Apple utilizes AI algorithms that are so sophisticated in their predictive targeting that Apple is willing to assume the entirety of the conversion risk.
Really?
They charge clients exclusively on the CPCU model. They only get paid when a user definitively converts, when they make a verified purchase or register a new account.
Wait, I have to push back on that. Isn't that incredibly risky for Apple?
How so?
If their AI has an off day or consumer trends shift overnight and nobody clicks buy, Apple literally doesn't get paid a dime despite spending money to serve the ads. How does a company maintain profitability taking on all of the client's risk?
It is an asymmetric risk model, and it only works if your algorithm is undeniably superior. By assuming the risk, Apple effectively eliminates client churn. Advertisers flock to Apple because it guarantees ROI. The specific business model is absolute proof of management's confidence in their AI's effectiveness.
That makes sense.
If the AI was flawed, Apple would go bankrupt instantly.
And the financials indicate the AI is definitely not failing. They have maintained a spectacular 5-year revenue SEC-GR exceeding 47% and a net income KGR surpassing 42%.
Unbelievable numbers.
Their net profit margins hover near a highly resilient 17%, and they operate virtually debt-free.
Apple is the textbook definition of smart, profitable growth without capital bloat. It aligns perfectly with the free cash flow and ROCE demands of the blueprint.
Okay, so we've looked at enterprise software, banking infrastructure, and consumer data algorithms.
Right, Jack?
But all of that is digital. What about the physical world?
Right, the hard stuff.
We established earlier that AI struggles to impact physical reality quickly. That leads to company number 4, Bosch India. This is a heavy manufacturing crossover.
Bosch India provides an avenue for investors seeking exposure to the physical infrastructure of the AI revolution.
Okay.
They operate 7 advanced development centers across India. Their mandate is integrating machine learning and AI directly into physical automotive components.
We are talking about the actual metal and silicon in a car. Explain the mechanics of this integration.
They engineer sophisticated sensors and electronic control units, or ECUs. An ECU is essentially the localized brain of a vehicle's subsystem.
Right.
As the automotive industry shifts toward autonomous driving and highly advanced driver assistance systems, these ECUs must process massive streams of visual, spatial, and telemetry data in real time.
So they need serious compute.
Exactly. Bosch is embedding optimized AI inference engines directly onto these physical units.
So the AI is running locally in the car, not just
Yeah.
pinging a cloud server.
Yeah.
And looking at the metrics, Q3 FY26 net profits grew by 16% year over year, supported by stable operating margins of 13%.
While lower than software margins, a 13% operating margin in heavy physical manufacturing is exceptionally strong. It proves they are successfully monetizing the difficult physical deployment of AT architecture.
Which brings us to the final company, number 5, L&T Technology Services, or LTTS. They are a pure-play engineering research and development firm.
LTTS focuses on deep domain digital engineering. Their AI model implementation is highlighted by a strategic partnership with NVIDIA, the dominant force in AI hardware architecture.
And what are they building with NVIDIA?
They collaboratively launched the AI Lung Digital Twin platform.
Interesting.
This is an advanced system for complex respiratory diagnostics. It utilizes AI to create a hyper-accurate, dynamic digital replica of a patient's lungs based on imaging and telemetry data,
Wow.
allowing medical professionals to simulate treatments digitally before applying them physically.
We discussed the bottleneck in physical healthcare trials earlier. A digital twin model is exactly how you accelerate that timeline. Financially, LTTS maintains an average top-line contract value consistently exceeding $200 million, demonstrating massive enterprise trust and the ability to secure long-term, high-margin revenue streams.
If we look at these 5 companies, Persistent, OFSS, AFL, Bosch, and LTTS, they all perfectly reflect the BCG 10-20-70 rule we discussed in Section 1.
Building on that, they aren't just creating an isolated algorithm and handing a client a flash drive.
Right.
Persistent integrates the AI directly into enterprise workflows. Bosch builds the AI right into the physical engine control units. Apple bakes the AI directly into the financial conversion model.
Yes.
They're actively solving the painful organizational and process adaptation for their clients.
Exactly. Because they solve the hardest part of the equation, they command immense pricing power, resulting in the high ROCE and free cash flow the Yart-Seba framework demands.
The numbers look pristine, the business models are fascinating, and the mathematical framework makes total sense. But, in investing, if you only look for what can go right, you will eventually lose your shirt.
Oh, absolutely.
You must ruthlessly search for what can kill the thesis entirely.
Stress testing your assumptions against macro realities is the only way to protect capital.
This brings us to Section 4, the reality check. The macro risks and bottlenecks. And based on the research, the biggest threats to these AT domain valuations aren't software bugs or rival algorithms.
No, they aren't.
The threats are hard, physical constraints. Let's start with the most critical bottleneck, the power grid.
We touched on the hyperscalers building gigawatt-scale data centers. The electrical requirements of these facilities are fundamentally unprecedented.
Really?
We are not talking about standard commercial power usage. We are talking about multiple gigawatts of continuous, uninterrupted baseload power.
Let's define baseload power clearly. Because when people think of green energy data centers, they assume you just strap a massive solar farm to the roof of the server farm and you're good to go. Why doesn't that work?
Because solar and wind are inherently intermittent power sources. They fluctuate wildly based on cloud cover or wind patterns. Baseload power is the heavy, constant, unyielding stream of electricity that never fluctuates, typically provided by nuclear, hydroelectric, or large-scale natural gas plants.
And why is an AI data center so sensitive to a power fluctuation? If a normal server loses power for a second, it just reboots.
Right, a standard server, yes. But training a foundational AI model is entirely different. The training process involves synchronizing tens of thousands of GPUs continuously for months at a time.
Wow.
They are constantly updating trillions of mathematical weights across the neural network. If the data center experiences even a microsecond power dip, the synchronization breaks. The weights can corrupt.
And what is the cost of that corruption?
It can completely invalidate the training checkpoint. The company might lose weeks of processing time, effectively vaporizing millions of dollars of least compute cost in an instant.
That's terrifying.
That is why uninterrupted baseload power is non-negotiable. If traditional utility companies and grid operators cannot expand heavy baseload capacity fast enough, the scaling of foundational models will hit a physical ceiling.
If the hyperscalers can't plug the machines in, progress stops entirely. And if the capability of the models plateaus because of a lack of electricity, the massive revenue projections for the entire applied layer collapse. The market multiple would violently contract.
What's fascinating here is that the biggest risk to AI isn't a failure of the algorithm itself, but a failure of the physical legacy world to keep up with it.
And the second major bottleneck is just as severe, but it exists in the digital realm: data exhaustion.
The current generation of large language models, the models driving the massive valuations today, rely entirely on ingesting vast, almost incomprehensible repositories of human-generated text.
Okay.
To make the models more intelligent, the primary mechanism has simply been to feed them more data.
But there is a finite ceiling to human output. We haven't written an infinite number of books.
Current estimates in the research present a startling timeline. The entire global stock of high-quality public text data is estimated to be somewhere between 4 trillion and 9 trillion tokens.
A token roughly equates to a single word or a piece of a complex word.
Yes.
We have ingested Wikipedia, Reddit, digitized libraries, scientific journals.
And based on current compute scaling laws, the models are devouring that data at an exponential rate. The projections suggest that we may entirely exhaust the supply of high-quality human text well before the year 2030.
We run out of human thought to feed the machine.
Basically, yes.
So basically, we are building the fastest, smartest, most expensive race car in human history, but we're about to run out of asphalt to drive on and gasoline to power it. The asphalt is the data, and the gas is the electricity.
That is a stark but accurate visualization of the bottlenecks. The AT industry recognizes this, of course.
Sure.
The proposed solution regarding data exhaustion is a heavy pivot toward multimodal data processing training models on massive repositories of video and audio streams and the generation of synthetic data.
Synthetic data, meaning an AI model, generates massive amounts of text specifically designed to train another AI model.
Yes. However, synthetic data introduces the risk of model collapse, where an AI training on AI-generated data slowly degrades in quality, like taking a photocopy of a photocopy over and over.
Right.
If the pivot to multimodal or synthetic data encounters friction, we will see a sudden, hard plateau in AI capabilities.
Okay, so knowing these massive macro risks, how does the individual listener execute this investment strategy without getting wiped out? Theory is great, but we need rules of engagement.
Definitely.
The source material outlines specific strategic execution protocols. First is mandatory annual rebalancing.
The AT domain is inherently susceptible to extreme hype cycles. It will experience periods of massive euphoric overvaluation, inevitably followed by deep, punishing market drawdowns.
You can't just set it and forget it.
I cannot simply buy a stock and ignore it for a decade. The framework suggests employing continuous mechanical risk management by updating your fundamental screens routinely, for instance, running the numbers every April or May following the release of year-end audited financial reports.
You have to re-verify the FCF over P and the ROCE every single year. But when you run those numbers, the research points out a very specific red flag filter, a trigger that mandates you immediately sell the stock. What is it?
You must mercilessly sell the equity if you observe that the company's total asset growth significantly exceeds its EBITDA or cash flow growth.
Break the mechanics of that down. Why is asset growth outpacing earnings a fatal flaw?
It is the ultimate indicator of dangerous corporate bloat. It means management is aggressively buying up assets, perhaps making flashy acquisitions of smaller AI startups or building expensive new headquarters.
Right, expanding.
Their balance sheet is getting much larger. But if those newly acquired assets are not translating into proportional, corresponding growth in operational cash flow, it means capital allocation discipline has broken down.
The company's getting physically bigger, but financially weaker. They're building an empire instead of building a business.
Precisely. In the high-velocity AT sector, empire building leads directly to multiple contraction. If you see that red flag, you must rotate out of the equity immediately, regardless of how promising the technology narrative remains.
Mercilessly sell.
Yeah.
No emotional attachment to the ticker symbol. And finally, the research warns against the most dangerous psychological trap for investors: survivorship bias.
Survivorship bias heavily distorts our perception of risk in technology investing. When we look back at the Yartseva study, we see the 464 companies that successfully executed their business models and became massive winners.
You only read the headlines about the 10 backers. You read the biographies of the brilliant founders who succeeded.
What you do not see are the thousands of equally promising companies that had brilliant technology, brilliant engineers, but ultimately failed.
Yeah.
They mismanaged capital, they took on too much debt, or they suffered a single fatal technological misstep and were wiped out.
The graveyard of tech startups is silent.
Exactly. True, multi-generational wealth generation in the AT domain does not rely on the mythical ability to pick one single perfect company.
No?
It relies on the disciplined construction of a diversified portfolio. A portfolio comprised exclusively of fundamentally pristine equities, rooted in rigorous free cash flow analysis, protected by the strict margin of safety demanded by a PEG under 1.0,
Right.
and held patiently as the underlying technological revolution compounds their fundamental value.
So what does this all mean? Let's bring everything we've unpacked today into a clear focus for you listening. If you want to find a multi-bagger in the AI era, you must completely tune out the hype narratives.
Completely.
Do not buy a stock just because a talking head on financial television mentions it, or because the company inserted the word generative into their press release. You have to rely on cold, unemotional mathematics.
Yes.
You want a company with a total enterprise value under $2 billion.
Yeah.
You want a high free cash flow to price ratio. You demand a return on capital employed strictly above 15%.
And zero debt.
You require zero debt, sustained margins above 10%, and a founder who owns half the company with absolutely zero pledged shares. You enforce valuation discipline with a PEG ratio of less than 1.
Exactly.
And fundamentally, you look for companies operating in the applied layer businesses that aren't just building neat digital toys, but are doing the brutal 70% cultural work of solving real-world, industry-specific problems like mining 5.0 or predictive healthcare integration. You now have a quantifiable, mathematically sound compass to navigate this AI supercycle.
It is a framework that prioritizes the preservation of capital just as fiercely as the appreciation of it. It provides the necessary margin of safety in an inherently volatile exponential industry.
We've covered an immense amount of ground today, and I want to leave you with one final provocative thought that builds right off the implications of this research.
Yeah.
We just spent this entire deep dive discussing a highly complex statistical framework designed by Anna Yartseva. We've talked about how to analyze massive data sets, screen for ROE, calculate free cash flow metrics, and allocate capital flawlessly to find multi-baggers.
We have.
But we also established that foundational AI models will be exponentially smarter by 2030. They will function as fully autonomous, highly rational, digital agents. So how long will it be until an AI system simply ingests the Yartseva study, processes the real-time financial data of every single global equity instantaneously, and uses this exact mathematical framework to allocate its own capital?
Wow.
When AI transitions from being the company we invest in to becoming the dominant market participant doing the investing, what happens to the human investor?
That is a profound question regarding the ultimate efficiency and perhaps the future existence of human-driven capital markets.
Something to mull over while you run your fundamental stock screens this weekend.
Thank you for taking this deep dive into the source material with us. We'll see you on the next deep dive.